Good afternoon. Welcome to the second part of this week's LPeC Showcase event, Exploring Listed Private Capital. I'm Chief Executive of LPeC, and we're the international group for listed private capital companies. We've got three of our companies presenting today: London-listed Oakley Capital Investments, CVC Credit Partners, also London-listed, and Helsinki-listed CapMan. For those of you new to this asset class, I'm going to spend a very few minutes talking about what listed private capital is and why it matters. Listed private capital is a way in which all investors can invest in private companies, particularly smaller retail and private wealth investors. Private capital provides finance to private companies to help them invest and grow. It's an important funding option for growing businesses, an alternative to bank funding or a public market listing. It fills the gap where banks are unable to lend or a public markets listing is unsuitable, often because a company is still not large enough. What listed private capital does is make the private public. Investors can buy and sell these shares in any amount at any time, exactly as they would any other share. Investing in private capital would otherwise be confined to large investors, pension funds, sovereign wealth funds, or large private foundations, for example. These have the resources to invest large minimum sums directly into big so-called limited partnership funds and don't mind if their money is locked in for 5 to 10 years. When you buy listed private capital, you might be buying shares either in a listed private capital company that manages investments, or in a fund managed by a private capital company, or in a fund of funds that works with many private capital managers taking stakes in a range of funds. No two companies or funds are actually exactly alike, and each has its own flavour. Some specialise in loans, listed private credit. Others take equity stakes, listed private equity. They may have particular geographic or sector focuses. Some are interested in companies at early stages of development, listed venture capital. Others in companies at a later stage, listed buyouts. Something for everyone. So why does it matter that small investors have access to private capital? Well, performance and diversification. On performance, I'll actually leave everyone to speak for themselves today, but I will make a general comment that over the last decade, listed private equity has outperformed global public markets by more than a third. And at the same time, public markets are now providing investors with less and less choice. The number of companies listed on public markets has roughly halved since a peak in the late 90s. Today, private capital is funding companies that have never seen a stock exchange, and in many cases never will. Where companies are coming to public markets, most of their growth is happening before they get there. There are now entire specialist subsectors not available on public markets: technology enablement or other smart industries, healthcare, companies at the forefront in sustainable and ESG strategies. Many national stock markets now have sector skews that means they no longer provide adequate diversification. But what listed private capital does is make all of this available to all investors: strong performance, exciting investment strategies, companies and assets that are otherwise not available. So now to our three companies to talk about how all this happens in practice. First up is Oakley Capital Investments' Steve Tredget. Steve.
Thank you very much, Deborah, and good afternoon to those that have joined us. As Deborah said, my name is Stephen Tredget. A partner at Oakley Capital, and I'm going to provide you with a brief overview of Oakley Capital Investments, otherwise known as OCI. So what is OCI? It's a listed investment company that was established and listed in 2007. It provides investors with exposure to a focused portfolio of equity stakes in high growth private companies. These are established, profitable businesses, typically growing their EBITDA around 20 to 30%. OCI achieves this by committing solely to the funds managed by Oakley Capital. So this is a listed direct private equity vehicle in contrast to some of the others that Deborah's mentioned, like a listed PE fund of funds or a listed private debt vehicle. Its closest peers are the likes of an HG Trust or an Apax Global or a 3i. So what's so great about Oakley Capital? Well, the manager Oakley Capital is focused on taking controlling stakes in small to medium-sized private businesses across Europe in 3 key sectors. Those sectors are technology, consumer, and education. But the clear focus is on digital business models, and we'll touch on that further later. And today, if you own the shares of OCI, you essentially have a stake in each of the 23 portfolio companies that sit within the Oakley Capital Funds. And the reason for this relatively ordinary photo of someone working at a laptop is to give you an immediate flavor of the type of companies and themes that we invest in. So this is a student studying an online degree course provided by IU Group. Now, IU is the largest and fastest growing university in Germany, which had, at the point when we invested it in 2018, 15,000 students. And today it has over 90,000, approaching 100,000 students. And that's thanks to the quality, flexibility, and range of study options the platform makes available to students globally. And those students would typically come from non-academic backgrounds, will be 25 to 35 in age, and will be fitting this around kind of current employment. So what makes kind of IU and what I've just described here, what's typical of this investment to the other Oakley investments? First up, it's growth. When actually IU's earnings grew around 70% in the last 12 months. So high growth is a typical factor and is the key method in which we are going to create value is through the revenue and earnings growth of these companies. Digital disruption is also at the heart of these companies' success. They're taking market share, or they're creating a solution that hitherto wasn't available to consumers or businesses. And it's also underpinned, that performance is underpinned not by economic or cyclical trends, but by long-term megatrends. Like in this case, the growing global demand for high quality, accessible education. In fact, education can actually be, kind of counter-cyclical as we consider, how these companies are going to perform in the uncertain times that we currently live in. So how does Oakley source exciting opportunities like this, and what's so unique about its approach? I'm going to do this in relatively quick order, so there's lots more I can discuss about it. But the key is this business founder network. Oakley was founded by an entrepreneur for entrepreneurs, in that we're an entity whose culture is that we understand what it is to be a business founder. We understand the support. We understand these aren't straightforward. They are non-compliant, kind of rule-breaking individuals. That's the essence of an entrepreneur's success, and we work well with them in the crudest description. And we now have 25 or more of these individuals that we've backed, some of them 3-4 times. So an incredible source of opportunities and incredible trust with these individuals. Those individuals have actually gone on to invest in the funds themselves. So actually some 300 million euros of the capital invested in the funds has been invested subsequently by the business founders we've had some success with. We're also backing companies that haven't accessed previously institutional private capital. So we're bringing more companies into the realm of private capital backing. Importantly, 3/4 of the deals we've done have been uncontested. There's been no competition at the time we've invested them. That speaks to the nature of the relationships, but it also speaks to the point at which the companies are at. The business founders aren't necessarily looking for an exit. They're not necessarily looking to maximize value at that point. They're looking for a partner to help them on the next stage of their journey. Their companies may not be, and often aren't, perfectly prepared for an auction. Now, the downside to that is that comes with a whole heap of complexity. These companies probably have difficult share registers. They might not have much management information. There probably isn't much in the way of kind of a large pool of senior exec management in the company. And whilst that is creates risk and complexity, if you can navigate that, if as we are set up and prepared to navigate that complexity, you get into these companies at really attractive entry multiples. Our average entry multiple to date is about 9.4 times EV/EBITDA. And that compares to companies that I've already touched on that grow on average their EBITDA at 30%. And that's an important point that I'll come back to later. I talked earlier about these mega trends. Let's touch on a few. It's important that within our focus sectors, we're investing behind these irreversible long-term trends that are in their relative infancy. And I think sometimes we're familiar with some of these trends within the UK, and we might think of property portals and think, well, we're all using certain digital solutions now and they've become ubiquitous. They may in certain sectors, but there are plenty of areas where they've yet to kind of truly penetrate. And so within technology, that business migration to the cloud is very much one that it still has a lot of white space, a lot of kind of distance to go, and certainly in some other areas within Europe, notably kind of Southern Europe, where it's really only just beginning at this stage. Or there's the consumer shift to online. It genuinely has only just begun in some sectors and geographies. I often talk about Italy in comparison to the UK. And there's some great comparisons. Car insurance, we own one of the largest price comparison websites in Italy. Car insurance in the UK, 80 to 90% is now arranged online. In Italy, even post the pandemic, it's only around 15 to 17% of car insurance that's arranged online. Only some 45% of the Italian population has done any kind of e-commerce transaction. I think it's fair to say, particularly with generation shift and with changes in behavior, which are happening, but they're just happening, 10 years behind, countries like the UK and Germany. So that shift is a trend that, regardless of the, Italian economy, our belief is that is a shift that's going to continue. And as I've already touched on, there is the growing global demand for quality and accessible education, that democratization of education that technology is allowing, and also will continue, regardless. In fact, in a difficult economic environment, people often, retrain or look for new opportunities, through education. And it's not just capital investment that we're providing here. Given our controlling stake, given our partnership with the companies and our expertise, we seek to create value regardless of the trading environment. Some of the key ways we achieve this is by improving the quality of earnings. This typically involves converting the businesses to subscription or recurring revenue models. There's the digitalization of companies. For example, in the case of LPeC, the designer homewares group that we acquired a couple of years ago, we've transformed its e-commerce offering, and we've grown its online sales from 5% of revenues to 30% of revenues in the last year or two. And this year, that will drive a doubling of its earnings in the 12 months. Another one that's absolutely fundamental to us is buy and build. We've made 40 platform investments to date, and those platform deals have acquired over 100 businesses between them. We're often entering into very fragmented markets, and we're bringing together subscale, single product companies to create an industry champion as part of that process. So let's focus more specifically on OCI and some of those kind of key stats you expect companies like us to put on the screen. NAV per share, that £5.71, and a net asset value that's just over £1 billion. Importantly, we just crossed over that billion threshold, which I think is important. I think it's scale for listed investment companies, all companies in health. You become more liquid, more wider ownership, and hopefully in time, you expect to trade more closely to your fair value. Now, we're not alone. The entire sector has sold off over recent months, and you can see the kind of distance there between the NAV per share and the share price. Now, one of the key reasons for that sell-off, I expect, is an uncertainty around the quality of the NAV. Is the underlying portfolio companies still performing and growing, and is the valuation that's applied to those companies still appropriate as it was in December or March? The last time we updated the public market was in April, when we gave our quarterly performance to the end of March, and the NAV had grown 6% in the first quarter. In a couple of weeks' time, on the 27th of July, we'll announce our second quarter trading update, and we anticipate outlining a similar level of performance so far this year. Encouragingly, we've got 200 million of cash on the balance sheet, and that's cash that's primed, ready to commit to the funds as the funds draw down and make investments. So in what we hope to be a period of incredible opportunity, the vehicle is well set to kind of meet the commitments that they've made to the funds. So here's just a bit more of that kind of longer term track record. You see the 6% growth to the pink bar in the first quarter of this year. But more importantly, look at the kind of gathering momentum of the performance of the funds, particularly as now we're a much more mature set of funds with investments that we've owned now for 3 or 4 years. The compound annual growth rate for the last 5 years just shy of 20%. And that is a growth rate that we expect to kind of continue going forward. And I think this year could be a really defining year for this asset class in general, not just for OCI. If we can demonstrate that we can continue to grow along similar lines, despite what's happened in the public market and despite what's happening in the wider economy, this will be a particularly kind of groundbreaking year for private assets, listed private capital, particularly laying to bed the kind of concerns that were raised by the global financial crisis back in 2007, 2008. So what's driving that NAV growth? The large proportion of it, this is what drove the 6% growth in Q1. The large proportion of it is the growth of the underlying portfolio companies. That is an accounting measure, and that is what's driving that 28% average EBITDA growth drove 75% of the asset value growth. There is a small amount of multiple expansion as well, and that's typically as a result of realizations in the period or companies that are maturing and are approaching the point of realization. So there's an increasing certainty over the likely exit value of those companies. If you want further reassurance about 14 times being appropriate, I guess there's 2 things to say. One is that on average, since inception, when we've sold an asset, we've sold it at least an average of 50% higher than the book value. And we've done that twice already this year in the teeth of what people would consider to be quite uncertain times. The other thing to consider is it's a crude comparison, but if you compare those metrics to the NASDAQ, let's say, the NASDAQ's growth is half of OCI's average portfolio company growth, and the portfolio average portfolio valuation is nearly double. It's about 20 odd in the early 20 times. So I think hopefully some quite attractive measures. Here's taking the asset value and dividing it down by company. What's the purpose of doing this? To show you how relatively evenly spread the division by company is, and also division by our 3 focus sectors. Notably, you have significant exposure to IU Group, which is probably the company we're most excited about at this point in time. Just as importantly is showing that division really exploring the fact that there's 2 key characteristics about all these companies. As you'll see, most of them are captured in some way by technology. They deliver their products or services digitally. And if they don't, and they sit outside that central part of the Venn diagram, then we've identified a way in which we can digitalize these companies and bring them into that center ground. The other key stat is that over 75% of those companies enjoy some kind of subscription or recurring revenue, which obviously adds another layer of resilience to these companies in the current environment. Just to kind of take a quick look at the kind of key factors that we are all naturally, concerned around at the moment, and the analysis that we're doing to understand the kind of likely impact of these factors on the portfolio. Very briefly, supply chain insecurity. I mean, we're not talking about companies that many of whom have any kind of supply chain. We're talking about digital consumer marketplaces, software as a service, kind of education and ed tech. There's very little disruption to supply chains in the majority of those businesses. Rising inflation, again, in capital-like companies, there's less of an impact that inflation can have on these companies. And in fact, they as a result, are producing, low-cost, disruptive solutions in markets where inflation could be having a more material impact on, typical businesses within that sector. So as an example, we have an online fitness app, which is clearly, potentially could perform well against physical gyms in a rising inflationary environment. We also have price comparison websites, which typically perform well in inflationary environments as people become kind of more cost conscious. So there is a revenue driver, or there is a competitive driver that we believe insulates us to some extent from inflation. On the subject of interest rates, we typically, particularly for private equity companies, have relatively low levels of debt within the companies. These are fast-growing companies. The majority of their EBITDA converts to cash. We have, on average, about 4 times EV/EBITDA debt within the businesses. And then finally, geopolitical uncertainty. We don't have a single investment within Ukraine, Russia, or Belarus, so have relatively limited direct impact, at least from the events that are happening there. So if there is if the questions that are on our mind at the moment are, how are companies going to survive with all these, kind of potential kind of headwinds? The other one being around multiples. Our portfolio company NAVs based upon multiples, which reflected the kind of fall in the public markets in recent weeks, months, over the course of this year. And to kind of illustrate why there is a lot of confidence in our current NAV and the multiples used, I've just very quickly here identified how we typically approach the valuation of a company over its 4 years. I've just taken the companies that we've realized to date. The multiples reflect, the mix of businesses that we have invested in, at that time, but the approach is exactly the same. So one, we get these really attractive entry multiples. I touched on how we do that earlier. We also take the view that there's 2 points you definitively know the multiple you can apply to the earnings of a business: when you buy it and when you sell it. In between, you can speculate and you can obviously have informed views. We take the view that it's much better and more accurate to peg it to that entry valuation. So you see in the first year of ownership, the multiple barely changes from the one we've made, and that's not untypical for us. Over the next 2 years, the multiple increases, but it's still relatively pegged to the entry multiple. It increases, reflecting the growth of the business, its continued success, improved quality of earnings, etc. Then, interestingly, you move into that final year, and this is the year that you are considering exiting the business. You now know the environment you're going to sell into, and the valuation multiple can start to reflect that. It jumps up even more at the point of exit, reflecting the fact that we sell at premiums to book. It's a conservative approach. In the world of private capital, you are not incentivized to overstate the value of these businesses. There's no management fee or performance fee you get. That is all driven. The performance fee is all driven at the point of exit. So overstating the value of a company on your book is not in your interest. I guess one of the other points I'm making is there's a lot of white space between the valuation we've managed to get into these businesses at and the valuation of the public markets. Also, as Deborah pointed out in her introduction, there are, in many of these companies, take for example IU Group, there is not a peer group comparison on the public markets. There might be university groups in North and South America, but they are very much, large listed campus university groups. And then just to bring to a close, kind of what can we expect share price drivers going forward? Continued performance is going to be absolutely key. And in a couple of weeks' time, we'll see how that's going. If we can maintain this kind of compound annual growth rate that we've been achieving to date, and the signs are relatively positive of that, then I think this will be a company that's got a bright shareholder return future ahead of it. Then there's news flow, always key to driving a share price. You've seen us exit a couple of investments today. You've seen us make some new investments today, and that is activity we expect to continue over the course of the next 6 to 12 months. We've also increased the regularity of the frequency of our reporting, and we are absolutely laser focused on the quality of our reporting. We're particularly proud that we've now won the AIC Best Report and Accounts now for the second year running. And we think that's absolutely key to the success of kind of a listed private equity vehicle, is to provide as much transparency as possible about what is in the business, what's within the portfolios and the nature of those companies, and give people access to those companies. And finally, the board's very much focused on continuing to close the discount. The discount except actually presents an opportunity to us because we can buy shares and cancel them at significant discounts to the NAV. And we have an outstanding program which still has £16 million to run on what's already been authorised. And you anticipate that the company will continue to pick up where it left off on buybacks post the trading update when it emerges from the close. So at that point, thank you for listening, and I'll hand over to Peter.
Thanks, Steve. My name is Peter Stalens, and I'm the portfolio manager for CVC Income and Growth Limited. For those of you that were on this call a year ago, you will have noticed that the name of the company changed. It used to be called CVC Credit Partners European Opportunities Limited, but we did find out that a lot of people didn't really understand what we were doing. So we changed the name of the company to CVC Income and Growth. And it's fairly simple. We try to deliver income from the coupons we're generating on the debt we invest in, and some growth because we do invest in some opportunistic debt, which we buy at a discount to par in the market. And then we do see some pull to par over time, and that delivers some capital growth to investors as well. I'll give you a very quick overview of the CVC group. I assume a lot of you are quite familiar with the larger CVC group. We are still one of the largest European private equity investors. You can see the private equity arm was set up in 1981, so we have over 40 years of experience of investing in Europe. And the credit business, which is roughly a quarter of the overall CVC group, was set up in 2005. So a lot of the members of the team have a lot of experience of investing through credit cycles. And we are in another credit cycle right now. So we've got a very experienced team that knows how to deal with this. And on top of that, we can tap into the larger CVC network. We've got offices, we've got 25 offices globally. We've got offices in all the major European cities, and they're not just small offices where I guess one or two people sit. These are large offices, and we do have a lot of local knowledge. So when we on the credit side were to invest, say in a Dutch company, we can always put a call into the CVC, into the Dutch CVC office, see if they know this company, if they know the industry, if they know management. And if they don't, they probably know somebody who does know this industry. So there's a lot of institutional information within the larger CVC group. A very brief overview of what we invest in. And this is quite a technical slide. I'm not going to go through this in a lot of detail, but the big difference between ourselves and a lot of other credit managers is that we invest in floating rate loans. And these are effectively private instruments. But a lot of credit managers that invest in fixed rate bonds, and these are public instruments. So it's a lot more accessible for investors to invest in public bonds. However, there aren't that many instruments available to get exposure to floating rate loans. You can see one of the main differences, which is the third bullet point here, is the interest. The interest on loans is typically floating rate, i.e. they are linked to the base rates of the local geography. So for example, in the UK, our loans would be linked to the Bank of England base rate. So in an inflationary environment, the Bank of England will typically hike interest rates, which means that the coupon we're getting on the businesses we lend to goes up. It's just like a floating rate mortgage effectively. Whereas a lot of bond managers, they would invest in fixed rate interests. And if in an inflationary environment, your coupon effectively loses value because your coupon at some point drops below the level of inflation. And you don't want to be in a long dated instrument when inflation is running very high. So that's why we believe floating rate loans should perform quite well in the current environment. I think the second main difference that I will briefly touch upon here is that we are senior and secured in the capital structure. So we are typically the top part of the capital structure, and there's usually a layer of equity below us where most of the private equity funds would invest in that equity. We invest in the top part of the capital structure, which does give less upside, but there's also a lot less downside. And we also have security over all or most of the assets of the company. So again, this is effectively like mortgage. The bank has security over your house. So if you were to default on your house, the bank takes over the house and they can then sell it in the market. So if someone defaults on their mortgage, that doesn't mean that that's complete write-off for the bank. There will always be some recovery. Whereas for bonds, a lot of these bonds are unsecured in nature, so the recovery is quite a bit lower. And you can see that on the next slide effectively. So we've plotted over the last 5 years, and that includes COVID, the default rates and recovery rates for European loans and European high yield bonds. You can see that over the last 5 years, the average default rate in the European loan market has been just below 1%, effectively 0.8%. In the European high yield market, it's been just above 1%, 1.2%. So you could argue these two markets aren't too dissimilar. However, when you look at recovery rates, which is the yellow line, the recovery rates for loans tend to be around 65 cents in the dollar, whereas for bonds, they tend to be around 40 cents in the dollar. So if there is a default, our loss rates are typically a lot lower than in the fixed rate high yield market. And that's why we think that loans are really interesting instruments at this point in the credit cycle. A, because their coupon goes up when central banks hike rates. So the Bank of England has hiked rates from 0.1% in December to 1.25% now. So that 1.15% delta has just been added to our coupons. And the expectation is that the Bank of England will continue to hike. And if things were to go wrong, then our recovery rates would be quite a bit higher than in the fixed rate high yield markets. And just again, to put it in perspective, we've seen a fairly material sell-off in loan prices over the last 2-3 months. And some of it is based on fundamentals, i.e. the world is slowing down, inflation is hurting the consumer, still supply chain issues. So the macroeconomic picture doesn't look as good as it did 6 months ago. But there's also been a big technical sell-off in our space where banks have been trying to delever their balance sheets by effectively selling a lot of loans in our markets. And the supply has been much higher than the demand for loans, which means that the price has come down. And just to put it into context, so the average price of the loans in our portfolio today is around 85 cents in the dollar. So if you take that 65 cents recovery into account, so that means if all our loans recover to par, we get 15 points upside from here on top of the coupon we're getting. If all our loans were to default, then you could imagine that the whole portfolio should trade at 65 cents in the dollar. So right now at 85 cents, the market effectively prices in that over 40% of our portfolio will default over the next couple of years. However, if you take into account the coupon, so the coupon on the fund is now around 10%, just to use round numbers. So if you assume that over the next 2 years, we can still clip that coupon, so that's 20 points of coupon on top of the 65 cents recovery, that's basically 85 cents. So if you take the coupon income into account, that means that our entire portfolio can default and investors still won't lose money. Of course, that's based on the 65 cents recovery, which we've seen historically. Some people could argue this will go down. If you say recovery rates go to 50 cents, then 70% of the portfolio can default and investors will be break even. So a lot of bad news seems to be priced in at these levels here. And if you look on the next slide, this is what some of the large banks expect as default rates going forward in the US and in Europe. You can see, maybe with the exception of Deutsche Bank, who's incredibly negative, most people who know the industry fairly well seem to think loan default rates are going to be anywhere between 1% and 3% over the next 1 to 2 years. So the market right now prices in incredibly high default rates, whereas a lot of people seem to think, you know what, default rates actually won't be that high. And we actually do think the same, because the market is still in a pretty good shape. On the next slides, I've got a quick snapshot of how a typical portfolio for us looks like. So you can see from the bottom 2 slides that these are fairly well diversified portfolios. So our largest sector is healthcare with around 14%. But you can see there's a long tail of other sectors, and we like to be diversified. And the advantage of where we invest in liquid instruments. So we can sell and buy these loans in a secondary market. So we can easily adjust our portfolio depending on how our outlook of the world is. So in terms of geography, you can see again, well diversified across Europe. We don't invest in emerging markets, so there's no direct Russian or Ukrainian exposure. Of course, there is an indirect impact, but you can see the current yields on the portfolio is 9.5% in sterling, and that was at the end of May. Since then, the Bank of England has hiked by another 25 pips, so that then effectively becomes 9.75%. And the consensus is that the Bank of England will keep on hiking at least another 2 or 3 cycles. So you could easily see that income go above 10% in the foreseeable future. Of course, euro income is a little bit lower because the ECB hasn't hiked as quickly as the Bank of England has, but the expectation is also for the ECB to start hiking. So at some point, we will see that the coupon on these European loans go up over time. I think that the final 2 things I would like to mention on this slide is the kind of companies we invest in. These are typically very large companies. So weighted average revenues across our portfolio is around 2.5 billion euros, and weighted average EBITDA is around 300 million euros. So these are large companies. These are not small companies where if the economy turns a little bit sour, that they will immediately default. These companies have a lot of options available. If things do go badly, they can sell some non-core assets. They usually are backed by very large private equity sponsors who have deep pockets. So these are large businesses. And I would also add the average leverage across our portfolio is around 5.5 times. So again, most private equity deals are done at an average valuation of, call it, around 10 times. So our loan to value on average is around 55%. So there's a large equity cushion below us, and the valuations of these businesses have to drop by quite a bit before the senior secured debt gets impaired. And then on the final slide, I mean, this is a slide that I showed last year as well. This is how our NAV, adjusted for dividends, performs against the FTSE, again, adjusted for dividends. And you can see that in periods of volatility, we tend to outperform equity markets. And that's just very simple because if valuations drop, the equity, of course, gets impacted first. And valuations have to drop a lot before the debt gets impaired. Of course, there is some mark-to-market volatility in the loans we invest in because there is a big liquid secondary market. And that's what we've seen this year. And you can see towards the end of this chart, we have underperformed the FTSE a little bit. And that's partially because of the technicals we're seeing in the markets where banks are deleveraging. They are selling some of their loans in the market at a pretty big discount to par. And that means we have to mark our loans there. I mean, there are loans marked in the portfolio that will mature in 3, 4, 5 months' time. That are marked at 95 cents. And that should, in theory, be taken out at par in a couple of months' time. So it's really the selling pressure from the banks that has weighed on our market. And on top of that, the FTSE has been one of the best performing equity indices so far this year, mainly because of the weak sterling and also the exposure to oil and commodities, which has really made the FTSE outperform a lot of other equity indices. So these are my prepared remarks. Happy to take any questions afterwards, but I'll first pass it on to Linda at CapMan.
Thank you, Peter. Good afternoon from a warm and sunny Helsinki. My name is Linda Tierala, and I'm Director of Investor Relations and Communications at CapMan, and I'm very happy to talk to you about our company, which may be a new acquaintance on the listed private equity scene for many of you. I'll provide a short overview of our company and our business model, and also go over the earnings logic, and present some of the key trends and developments in the strategy and the portfolio. So CapMan was founded in 1989 as one of the first private equity companies in the Nordics. So this means that we've been active in the market for over 30 years. And we've been listed on the Helsinki Stock Exchange for more than 20 years. So we are a pioneer also in that sense. We have a presence in all of the Nordic capitals except in Iceland. We have offices in Helsinki, which is our headquarters, in Stockholm, Copenhagen, and Oslo. And then we also have a presence in Luxembourg and in London. Currently, our portfolio has around 250 companies and real estate assets. So we cover the full spectrum of private capital, from private equity to real estate and to infrastructure as well. We have approximately 270 limited partners as investors in our funds. These are mostly pension funds and insurance companies, but an increasing number are also large international investors from the US and from continental Europe, UK, and from Asia. So the majority of our LPs actually come from outside the Nordic countries, and our assets under management are almost 5 billion euros as of the end of March. So investing in CapMan's stock is that's actually a very liquid way of accessing a diversified portfolio of unlisted companies, real estate, and infrastructure in the Nordics. I'll briefly present CapMan's business model and our earning streams, as this differs a bit from the listed direct fund model that many other listed private equity companies follow. So CapMan is a listed private assets manager, which means that we manage mostly closed-end funds that invest in private assets according to various strategies. And these funds are organized as limited partnerships, and they're not directly owned by CapMan. So rather, we act as a fund manager and we receive management fee from the funds as well as carried interest. And in addition to this fund management business, we have a service business that offers private equity related services. The fee component, both from management fees and from service fees, is highly predictable, and we can forecast that many years forward. Typically, the funds have a 10-year term, and the initial fund size, as well as the acquisition value of the underlying portfolio, determines the magnitude of future management fees for the lifetime of the fund. And then carried interest, that's determined based on the success of the fund, and that's paid to us as fund managers then when the fund has repaid the invested capital back to its limited partners, in addition to a hurdle rate. So in addition to managing the funds, we also invest from our own balance sheet, mostly in our own funds, and we do this alongside our limited partners. So the earnings from this business segment, that comes from realized returns of the portfolio as well as fair value changes. So CapMan is a multi-product house. This means that our portfolio is extremely diversified, both in terms of sectors and types of assets. We have 3 distinctive investment areas. These are private equity, real estate, and infrastructure. And further, these areas are divided into several different investment strategies. So, for example, our real estate business invests in both value-add and income-focused real estate across the Nordic countries. An example of this is hotels. We manage the largest hotels fund in the Nordics. Infrastructure, that's our newest investment area, and we currently have 1 fund and then have a couple of mandates that we manage in this investment area as well. On the private equity side, this is typically sort of what you think of when you think about private capital. Here we cover the full spectrum except very early venture capital. So we do buyouts in Nordic mid-market companies. We do more early stage growth investments. These are done as minority investments. And then we also invest in sort of transitional companies through our special situations focus. And we don't really have an industry focus, but the teams, they pick interesting growth stories or niche market leaders across sectors that they focus on. But all of our investment areas have in common is the Nordic market. So we invest exclusively in the Nordic countries. The impact that we have through our investment is quite significant. So these altogether 35 portfolio companies, they have an aggregate of 13,000 employees and an aggregate turnover of some 2.2 billion euros. And if we look at the real estate, the properties that we invest in, they have an aggregate square area of 1,300,000 square meters and some more than 6,000 tenants. So we sort of see this as as the overall handprint of our business. As a significant investor, we have a responsibility to the different stakeholders of these companies and also for the assets that we invest in. And therefore, we've worked quite a lot with our ESG strategy in the recent years. And we have identified 3 focus areas in terms of sustainability and set ESG targets for these areas, both for our own operations, but then also for our portfolio companies and our real estate operations. So in terms of an environment, our focus is on reaching a net zero economy over years. And we want to do this by committing and then eventually setting science-based targets, both for CapMan as a private equity firm, but then also by helping our portfolio companies commit to and set science-based targets for themselves. And in terms of real estate, in addition to setting science-based targets for the real estate assets, we also focus on other environmental indicators, for example, sustainable building certifications and the number of green leases that we have for our properties. When it comes to the social spectrum, we see that having a more diverse workforce and more diverse decision makers is key. And then also having sort of a workforce that is doing well and that's proud to work for the companies that we invest in. And the way that we look at this is by monitoring employee satisfaction. So we want to make sure that our both CapMan and our portfolio companies that we reach employee satisfaction above certain thresholds. And in addition to that, we create a policy and a process for diversity and inclusion in our own operations as well as in our companies. And we also follow job creation for our portfolio companies. And then when it comes to governance, we look at the diversity of decision makers through board representation, and we look at integrating ESG factors into decision making. So the way we are doing this is developing the employee remuneration to include ESG targets, and then to develop a process to reach equal gender representation, both in management groups and at partner level throughout our organization. And then when it comes to our portfolio companies, we've now set a target to appoint a max 70% of any gender to boards and management teams. And this is something that we sort of have as an interim target and moving towards a more equal distribution and then in the future. Similarly, we also want to integrate sustainability objectives in the remuneration for the management teams in our portfolio companies. These are targets that we now set for 2022, and we are going to evaluate these ESG targets continuously. And still, we do recognize that we are still only in the beginning of our ESG journey, but we do think that by helping our portfolio companies set relevant goals, we can achieve great results on an aggregate level and really make a difference. And one way to illustrate this through an example of how we actually drive ESG action through our portfolio companies. And these 2 examples are from our infrastructure fund, which is quite natural because the strategy of the fund is to invest in energy and in transportation and digital communications industries. And both energy and transportation are quite emission-intensive businesses where there's a lot to gain if we are able to get a transition for the business. So, for example, for Nordled, which is a ferry operator in Norway, they manage both express boats and larger ferries that operate in the fjords. They've set a greenhouse gas reduction target of 67% from by 2030 from 2019 levels, and they want to become a 2040 or they want to become a zero emission company by 2040. And we're actually quite happy to see that now already in 2021 they were almost half of the 2030 objective. So that's very, very encouraging to see. And in terms of Koiviston Auto, which is Finland's largest bus operator, we are pursuing the more or less the same strategy. but this time on land-based traffic. So here we are helping the company to convert these diesel-driven buses into non-emission vehicles. And this also will significantly reduce the greenhouse gas emissions of the business. So now I'd like to go over some of the more recent developments in our company and our figures. And looking at the first quarter of 2022, we had a really, really strong performance in almost all regards. And this is sort of a continuation of several quarters of very, very strong performance across the board. So assets under management, that was up some 22%. The turnover was up on 26%. Fee profit, that was up 23% from the same period last year. And operating profit, that was up 86%. That was mainly due to really, really strong fair value gains. So we're very happy with the start for the year and look forward to continuing now as we move along. So the growth metrics that were shown on the previous slide, those are mainly driven by growth in the assets under management. The majority of our assets under management that comes from real estate funds. So that's a bit more than 3 billion euros. Private equity funds, that's about 1 billion, and then infrastructure, that's sort of still a small but fast-growing share of our assets under management. That's at some 400 million as of end of March. And all in all, we have some 4.7 billion euros in assets under management. And the development of CapMan's assets under management, that's a really important indicator for future earnings potential. So the assets under management, they've increased really significantly in the past 5 years, and the sources have diversified quite a lot with new investment strategies and funds launched every year. And we have a really strong pipeline of successor funds in all the strategy or all the investment areas within private equity, in real estate, and in infrastructure. So we expect to continue this trend on mid to long term. So then where does this assets under management come from? Still, some 40% of our investors come from the Nordics, but we've increased the share of international investors quite a lot over the few years. So rest of Europe and North America are gaining share here. And pension funds are still the most typical investors, but we also have a lot of smaller institutional investors as well as our LPs. And this is actually something that we focused on when we look at our strategy. So broadening the access to capital and broadening the LP base has been one strategic objective. So moving sort of from these large Nordic institutions towards a more diversified LP base is key. And here, as you can see, we've been able to increase that from 10% in 2016 to almost 60% in 2021, 2022. And this, at the same time, we've also increased the share of these sort of smaller Nordic tier 2 and tier 3 investors. And then the other strategic objective that we have is moving from more closed-end funds to different types of funds, such as open-ended and more mandates and club-based investments. And the share of those investments have risen to almost half of all our assets under management, compared to being just 4% in 2016. And the third strategic objective that we have is to broaden the offering. So having sort of previously been very private equity or even maybe even buyout focused, a buyout focused company, we now are truly a diversified private equity multi-product house. So we've increased especially the real estate and infrastructure service offerings by quite a lot in the past few years. And this is this sort of a development in our strategy that's visible also in our figures. So if you recall the earnings components that we have, service fees are sort of the bulk of the earnings. these have grown really significantly in the past few years, so by 17% over the past 5 years. And similarly, also profitability, that's increased by 47% in the past 5 years. So this shows that sort of the increased diversification that really pays off. Just a couple of words about the balance sheet. As we invest alongside our LPs in our own funds, we make sure that we have a strong balance sheet and that we're well capitalized. Earlier this year, we issued the first ever sustainability-linked bond in Finland. So that was 40 million in senior unsecured debt. This bond was tied to 2 performance indicators. The first one being having greenhouse gas emissions reduction pathway validated by the science-based targets, and then the second one will be to integrate ESG targets into management remuneration. So these targets are fully aligned with CapMan's ESG targets overall. So looking longer term, we focus on 4 different financial objectives. So the first is growing the management company and service business by more than 10% annually. We've done very well here in the past 4 years. So and also continued on the trajectory now in 2022 in terms of achieving more than 20% in return on equity. We've done okay over the past 3 years, but then keep in mind that there was a hit from COVID, so that's also reflected here in the figures. The 2022 figures were really, really strong so far. And then in terms of equity ratio, we target an equity ratio more than 60%. We've averaged very close to that over the past 3 years, but then in this year we've been slightly below, but then it's still on a very, very solid level. And then finally, we seek to distribute a growing dividend to our shareholders annually. And this is something that we have been able to achieve since 2012. So one of the sort of more consistently great dividend payers on the Helsinki Stock Exchange. So that's it for me. I'd like to thank you very much for your attention. And now I'm pleased to hand over to Tamsin, who will introduce the Q&A session of this webinar. Thank you.
Thank you, Linda. Steve, we'll go to you first. In the current environment, are you focusing your attention on more UK investment opportunities, or is there a shift to other countries within Europe?
Well, the quick answer is no. I think principally because we tend to focus more on the opportunity first. So we have sectors that we're focused on. We find the opportunities, the individuals we are back, they matter to us more. The geography is essentially a secondary point there. The reason we haven't invested more in the UK more recently is because it's incredibly competitive. That means, it's very intermediated. It's very hard for us to find value, or has been historically, and so it's been less of a region of focus for us. Unlike Germany, Italy, Spain, Portugal, France, where we've been a lot more active. That said, whilst we're not predicting any, additional, or greater activity in the UK, clearly the current environment could, provoke more disruption, dislocation. The IPO market's clearly not functioning at the moment, and so it's highly possible that more attractive opportunities, become available in the UK. But we're certainly not relying on that or forecasting that.
Thank you. And Peter, what are your sector preferences given the macro outlook?
Yeah, we can obviously shift our portfolio fairly easily by moving from one sector to the other. I think one space we like well at this point in time is, for example, the travel and leisure sector, which is still recovering from COVID. But there are a lot of opportunities there. All the data points we see point towards a pretty strong summer, assuming planes fly, of course, which is maybe a different question, especially in the UK here. But that's a sector we quite like. We had a call yesterday with a cruise operator. They said bookings for this year are packed. The bookings for next year are looking very strong, even if they push through price increases. So that's a space we like. You've probably seen the slides. We like the healthcare sector. Because again, that should be fairly resilient. There's obviously some other sectors where we are a lot more cautious about. I think it's anything which has to do with the consumer actually buying goods rather than services. I think that could struggle going forward. But in general, we feel quite happy with the portfolio as it is right now, and especially with the way we can shift our sector allocation.
Thank you very much. And we've got another question for Steve. Are you experiencing a slowing of deal activity, or do you expect a slowing in the 6 months ahead?
We haven't. No, I think the key thing, I mean, before anyone assumes that's the same for all of kind of all asset classes or all private equity. I mean, I only speak for our particular experience, and we're relatively smart. I mean, we expect to do somewhere in the region of 3 to 6, make 3 to 6 investments a year, and we might dispose of kind of 2 to 3. So we're hardly the litmus for the entire market. However, we have not seen a slowing in either investment opportunities or realization opportunities. And I think what slows things down is you see a declining in performance, which obviously makes either businesses you hold on to a business longer, so you see recovery, or of course if your company underperforms, then it becomes less attractive, and so you might see less interest in it if you wish to sell it. Clearly, the other thing is uncertainty. If a business's performance is uncertain in the current environment, it's very hard to price that company, and therefore it's not a reason why you start to see a tightening of activity. And then finally, it's liquidity from a kind of particularly from a debt perspective. Well, this is not the global financial crisis. We are seeing liquidity. We might see kind of the cost of debt go up. And then if I focus on kind of why we're seeing plenty of activity still. If you have companies that are proving resilient, that are performing well, then the interest in those companies is as kind of strong, if not greater, than ever. And typically, you can think of OCI or Oakley, doing the messy work, getting their hands dirty in the kind of companies to create much bigger businesses, which then are attractive to the much larger global PE houses. We're kind of the PE manager for PE managers, if you like, and we are having extensive conversations with lots of sponsors about the majority of our portfolio, and the sale of 3 assets so far this year is indicative of the interest in the portfolio as a whole. Of course, conversely, we all know that fund vintages that follow periods of disruption, particularly economic disruption, are some of the best performing vintages there are. And clearly, as I touched on, talking about the UK, we're already seeing that increased uncertainty, maybe companies that worry about their existing capital structure, maybe a bit of dislocation is leading more people to have more businesses, more business plans to have conversations now, maybe a bit earlier than they were anticipating. And we're seeing our pipeline of opportunities be as strong as it's ever been.
Tremendous. Thank you very much. And for Linda, do you also target ethnic or racial diversity, or do you only focus on gender equality?
That's a very good question. We only focus on gender equality. I take that this question is coming from the UK market, where things are sort of maybe historically a little bit different than here in the Nordics. Here we have sort of quite strong laws preventing us from actually gathering data on ethnic diversity. So it's sort of, we can't sort of really pursue that at all. So the focus is therefore purely on gender now.
Tremendous. Thank you very much. And for Peter, how do you see the evolution of credit markets from here?
Yeah, I mean, credit markets typically always go through cycles, and So what we've seen over the last few months is a big sell-off, and as Steve alluded to earlier, the cost of debt is going up for a lot of companies, and that always means some volatility. The supply needs to meet demand somewhere, and we are getting close to a level where we can actually say, okay, well, the cost of debt used to be this, and now it's going to be that. It has gone up. So, but while we are going through one of these repricing cycles, there is always volatility in the market. So that's what we see now. The other point in the credit cycles is default rates, and as I mentioned earlier, we don't expect default rates to pick up materially from here. They may pick up a little bit, and of course, there's still a lot of macro unknowns out there. For example, what is Russia going to do with its gas supply to Germany, which could of course have a big impact on the economy. But generally, the businesses we lend to are in fairly good shape. So there are different views on where we are in the credit cycle, but we're still quite positive on credit here, because a lot of bad news is in the price right now, as I tried to explain earlier.
Many thanks. That's tremendous. And I'm afraid we've run out of time. But many thanks, Stephen and Peter and Linda, for great presentations. Many thanks for joining.